Welcome to the final episode of All About Economics. We have traveled from the Keynesian revolution through money, inflation, exchange rates, and the Israeli economy, and then through risk, bonds, stocks, and options. Today we tie the finance track together the way a real exam does, with the core tools of capital budgeting, the methods every analyst uses to decide whether an investment is worth making. We will master net present value, the internal rate of return, the profitability index, the effective interest rate, the Spitzer loan, and the role of depreciation and taxes. And we will uncover the single elegant relationship that ties the first three together. Let us finish strong. Section 1. The Decision Toolkit. Every business faces the same fundamental question: should we invest in this project or not? Finance answers it with a toolkit built on the time value of money, the very idea we met with bonds. A project is just a stream of future cash flows, some out, some in, and the question is whether those future flows, properly discounted to today, are worth more than the money we must put in now. The exam staples, net present value, internal rate of return, and the profitability index, are three different lenses on that one question, and the deeper you understand how they connect, the faster these problems dissolve. Let us take them one at a time. Section 2. Net present value. The flagship tool is net present value, or NPV. You take every future cash flow a project generates, discount each one back to today at the company's cost of capital, sum them up, and subtract the initial investment. The rule is beautifully simple. If the NPV is positive, the project creates value, so you accept it. If it is negative, the project destroys value, so you reject it. For example, invest a sum today, receive cash for several years, discount those receipts at 8%, and if their present value exceeds what you put in, the NPV is positive and the project is worthwhile. NPV is the gold standard precisely because it tells you, in today's money, exactly how much wealth a project adds. Section 3. The internal rate of return. The second tool is the internal rate of return, or IRR. It asks a clever question: what single discount rate would make this project's NPV exactly zero? That break-even rate is the IRR, and you can think of it as the project's own built-in rate of return. The decision rule, then, is to compare the IRR to your cost of capital. If the IRR is higher than the cost of capital, the project earns more than your money costs, so you accept it. If the IRR is below the cost of capital, you reject it. The IRR is intuitive because it speaks in percentages, a single number that says, this project effectively yields this much. Now compare that to what your financing costs. Section 4. The elegant equivalence. Here is the insight that exam questions love to test, because it ties the first three tools into one. For a normal project, these three statements are always equivalent. They rise and fall together. NPV greater than zero is the same as IRR greater than the cost of capital is the same as the profitability index greater than 1. All three say the identical thing: the project is worthwhile. And flipped, NPV below zero means the IRR is below the cost of capital, means the profitability index is below 1. All three say, reject it. So if an exam asks why a project with a negative NPV should be rejected, the airtight answer is, because its IRR is below the cost of capital and its profitability index is below 1. They are three faces of a single truth. Section 5. The Profitability Index. That third face is the Profitability Index, or PI, and it earns its place by handling a problem NPV alone cannot. The PI is the present value of a project's inflows divided by the initial investment. A PI above 1 means every shekel invested returns more than a shekel in today's terms, so the project adds value, exactly when NPV is positive. But the PI shines when you have limited capital and must rank competing projects. NPV tells you the total value added, but the PI tells you the value added per shekel invested, the bang for your buck. When your budget is tight and you cannot fund everything, you rank projects by their profitability index to squeeze the most value from every shekel you have. Section 6. The effective interest rate. Now a tool that catches people constantly, the effective interest rate. A loan or investment might quote a nominal rate, say 12% a year. But if interest compounds more often than once a year, monthly, say, the true rate you actually pay or earn is higher than the quoted figure, because you pay interest on interest within the year. That true rate is the effective interest rate. 12% quoted, compounded monthly, works out to an effective rate noticeably above 12. The lesson echoes our bond episodes. Never trust the quoted, nominal number. Always compute the effective rate to know what you are really paying. The more frequent the compounding, the wider the gap between the nominal headline and the effective reality. Section 7. The Spitzer Loan. A classic on every finance exam is the Spitzer loan, the standard equal payment loan that powers most mortgages. In a Spitzer schedule, you pay the exact same total amount every period, but the composition shifts over time. Early on, most of each payment is interest because the outstanding balance is large, and only a little goes to principal. As the balance shrinks, the interest portion falls and more of each payment chips away at the principal. By the end, almost all of your payment is principal. Building the amortization table, splitting each equal payment into its interest and principal parts, and tracking the falling balance, is a rite of passage in finance. And once you see the pattern, every mortgage statement suddenly makes sense. Section 8. Depreciation and the tax shield. The final piece is how taxes enter an investment decision through depreciation. When a company buys a machine, it cannot deduct the whole cost at once. Instead, it writes off a portion each year as depreciation. Now, depreciation is not a cash outflow. You do not write a check for it, but it is tax deductible, and that is the magic. By reducing taxable profit, depreciation lowers the tax bill, and that tax saving is a very real cash inflow, the so-called depreciation tax shield. So in a proper capital budgeting analysis, you must add back the tax savings from depreciation to the project's cash flows. Ignore the tax shield, and you will undervalue the investment and possibly reject a project you should have taken. Conclusion. We have completed the finance track, and with it, the entire All About Economics course. The capital budgeting toolkit comes down to one question. Does a project add value? Answered by net present value, by the internal rate of return against the cost of capital, and by the profitability index, three faces of a single truth. Always compute the effective interest rate rather than the nominal one. Master the Spitzer loan that underlies every mortgage, and never forget the depreciation tax shield. Step back and look at how far you have come, from the foundations of macroeconomics to the precise tools of modern finance. You now hold a genuinely connected understanding of how economies and markets work. Thank you for taking this whole journey with me. If this course added real value to your understanding, please subscribe to All About Economics, share it with anyone learning the subject, and keep asking how the pieces connect. This has been All About Economics.